Good morning, and welcome everyone to this special event. As we all well know, 2022 has been a year of many changes that has thrown up a lot of questions. And to answer these questions in a detailed manner, we have a range of expert speakers lined up throughout the day. So let's look at the structure of today's proceedings. From the macro view to the big ticket private equity panel in the morning, to the venture capital and growth capital panels in the afternoon, we will be able to focus on specific issues relating to each segment of the private equity funding ecosystem, and plenty of time for interactions both during the panel discussions and the networking breaks in between. We also have sector specialists, including investors from the healthcare, crypto, and climate tech domains as part of the post-launch panel. And we'll also have an interesting perspective from the banking side from DBS on how the bank is working proactively with investors and speakers. With that, to set the stage for the panels to follow, let me start the day's proceedings with a presentation on what the data says on the state of private equity venture capital in the first 9 months of 2022. Now, data lends itself to be perceived from varying angles. You could be an investor, an advisor, or a company seeking funding, and each of you would have a unique perspective on what the data says. And today we're going to be presenting to you our perspective, that is that of venture intelligence. Now, we take this opportunity to thank our title sponsor Trilegal, co-sponsor BDO, and powered by partner Ambit. Gold partners Tata Capital Healthcare Fund, Gaja Capital, Stakeport Capital, Lighthouse Funds, Motilal Oswal Private Equity, Carpe Diem Capital, and silver partner Special Invest. And our knowledge partner, executive search firm Native. To give you a quick note on who we are and what we do, Venture Intelligence has been a data provider since 2002, and today's data has been taken from our private equity deals database. Of course, we do have a couple of other databases for you to explore, including our mergers and acquisitions, private equity participation real estate, and a wholly dedicated company financials database. We also have a newsletter that goes out every morning, giving you the morning's dose of private equity. If you visit our website, you can check out our blog and also download our various reports, such as our Unicorn report and our Series A landscape report that I believe you'll find quite interesting. This morning, we'll be looking at the private equity space, and we'll be focusing on the subset VC towards the second half of the day. You'll notice that there's been a decline. Sorry, just a second. All right, great. So you'll notice that there's been a decline on a quarter-on-quarter basis, both in terms of value as well as the volume of the investments that have happened. But let's just zoom out a little and look at this from a more yearly angle. We see that the 9 months figure indicate that come the year end, 2022 of all the other years is going to be much bigger and better, barring of course the anomaly that was 2021. So let me just show you exactly what kind of anomaly 2021 was. So you'll notice that unicorns have been a hot topic, with 44 unicorns having been created in 2021 versus the 21 unicorns that have been created this year. You'll also notice that this number, that is the 21 unicorns, is far greater than even double any of the previous years, that is prior to 21. You'll also notice that 2021 seems to favor B2C companies turning unicorns, but we have more B2B domination this year with 12 versus 9. Of course, I would urge you to check out our unicorn tracker on the same so that you have a better perspective of what exactly is going on. Now, so this gives you a quick look on the unicorn creation on a quarter-on-quarter basis, with more unicorns being created in the first quarter of this year, almost on par with the quarter previous to that. Now, but the number has dropped, indicating that there is a fall in the number of the big deals in the recent months. Carrying this forward, let's shift the angle a little bit to the deal size. We know that mega deals, that is deals that are an investment amount of more than 100 million and over, are falling, both in terms of the amount of investment as well as the average check size. So while mega deals were driving 78% of the deals in 2021, quite in line with the unicorn creation, the number has fallen to a 66% in the 9 months of 2022. In this vein, let's look at some of the top deals thus far. While tech still does feature in the top deals, we see some variation in the industries that are hitting these ranks. You'll also notice that save for one deal, these top deals have all occurred in the first half of the year. And industries like energy, telecom, and BFSI are seeing mega deals, and we're witnessing these companies entering these ranks. Unlike 2021, which was heavily tech dominated. In fact, of the top 12 deals that happened in 2021, only 2 of them weren't tech. So let's explore this industry angle further. We see that 2022 has lent itself to greater investments in other industries, with IT and ITES facing a dip. While it's true that IT was all the rage in 2021, you'll see the sharp increase from 2020 to 2021. 2022 seems to have paved the way for more diversification in investments. Exploring just another standout trend on this chart, you'll notice that the telecom for 2020 is quite large. So this is all thanks to Reliance Jio's having raised nearly about 9 billion from various PEs. Now, let's consider the data from yet another angle, wherein we're looking at investment stages. Now, across the stages, there does seem to be a decline. In cases such as the late stage, the amounts are at 21 billion in 2021 versus only 11 billion in the 9 months of 2022. While this still seems roughly the same in the share of the pie, the amounts involved tell a different story. Later stage deals, which correlate with the mega deals, have fallen as the data had revealed earlier. In comparison, the VC segment, represented by the early and growth stage, has had a much milder fall from 2021, and this, of course, is going to be discussed further in our panels as well as the post-launch session. Now, we are in the last leg of the year, and 2022 has shaped up to be bigger and better than the previous years, barring, of course, once again, the anomaly that was 2021. And while we've seen some decreases in the numbers and the late stage may be hurting, non-traditional sectors are growing compared to the previous year. In fact, sectors such as biotech is doing better than it was in 2021. We also see certain cities and stages being gainers, attracting a large volume and a value of investments even higher than in the previous year. Now, there is quite a lot of churn in the PE space, and given the uncertain environment, we're proud to have our inaugural panel titled The Macro View that has representation from the entire spectrum of stakeholders in the PEVC ecosystem. So I'd like to call upon stage our panelists, Gautam Singh, partner, Trilegal. If you could please come up, yes. We have Vikas Khattar, co-head of investment banking and head of ECM FSG, Ambit. Ruchira Shukla, regional lead, South Asia, Disruptive Technologies, wherein she's in direct investing and VC funds, and global sector leads, HealthTech IFC. Abhay Pandey, general partner, A91 Partners. And Vikram Gupta, founder and managing partner, IvyCap Ventures. Thank you for being here today. I'd like to introduce our moderator for this panel, Gautam Singh, partner, Trilegal. Gautam Singh is a part of the corporate practice group. He primarily focuses on mergers and acquisitions, private equity investments, exits, workouts, and restructuring. Gautam actively advises his clients on their regulatory and contentious matters. His experience of working on entire deal cycles, including contentious exits, and his regulatory insights help him develop and implement commercially pragmatic legal solutions for his clients. Some of the clients Gautam has advised include BlackRock, Morgan Stanley, Lightrock, York Capital, Circulate Capital, Standard Chartered Bank, Louvre Hotel Group, Goldman Sachs, Swiggy, and Etihad. I'd like to hand over the session to Gautam now.
So many faces after a hiatus of about 3 years now. If I may request the panel to introduce themselves.
Great to have here. I'm Vikas. I co-head the investment banking business. Good morning, everyone. Hello. Can you guys hear me? Yes. Perfect. Good morning, everyone. I'm Vikas. I co-head the investment banking business for Ambit and take care of the capital market business also. Happy to be here and share my thought process as well as learn about how the other people are thinking about the macro trends.
No.
this works, right? Yeah, okay. Ruchira Shukla with IFC, and I do direct investing as well as VC fund investing in South Asia. I also lead the HealthTech business globally. We typically come in Series B and later occasionally look at Series A assets on the direct side. On the VC fund side, we are stage agnostic, but have more seed and Series A funds in our portfolio. Happy to be here and looking forward to an interesting discussion.
My name is Abhay Pandey. I represent A91 Partners, which is, in our jargon, a late venture early growth fund. It's a relatively new fund. It's about 4 years old. And in the 4 years, we made 20 investments so far. So early days in our business, but happy to be here and share my thoughts and learn a few things here.
Vikram Gupta, I'm the founder and managing partner at IvyCap Ventures. We are a seed to Series B investor. Manage about 4,000 crores, all domestic capital. We made about 35 investments so far. Thank you.
So straight off the bat, looking at the numbers, is it really a doomsday scenario? Each one of you has been actively involved and have a very different vantage points. Is this 2020 just rebalancing the excesses of 2021 when free liquidity made sure that everybody goes into a deep slumber of sorts where there was no fundamentals, deals were being done day after day. We've heard promoters actually say that this is the valuation because I feel it is. No justifications given. So is the pain real or is it perceived? How are you seeing this pan out in your portfolios, your fundraise? Happy to hear your thoughts.
So we're in the process of closing a 2,000 crore fund, so we're almost there, very close to just closing the fund. We sold domestic capital, and we have started investing already from our fund 3. This is our fund 3. So from an investing perspective, I think we actually are seeing a good market from that perspective, and we're seeing the valuations to be very realistic. Of course, the last year, as we're talking about, was an aberration. If you were going out to do deals, there was a huge amount of capital flowing, chasing fewer deals. The valuations were actually quite high at that time. So if you're actually in the market under pressure to deploy capital, I think that was probably not the best year to deploy capital, because we are seeing Series B deals today at Series A valuations, or even at discount to Series A valuations. Right? So I think that's something very interesting. But I think it's also separating good entrepreneurs from average entrepreneurs. I think we've seen that people who have stuck to their core, their fundamentals, I think they have actually continued to do well. And some of them are really commanding valuations that they deserve. And they're getting capital. So I think I mean, 2021 rightly called as a maybe an aberration somewhere between this time. But I think if you just compare the years before that and 22 with the years before that, before 21, I think you'll see 2022 actually doing much better and 23 doing even better. So I think that's the way we are looking at it.
The question is the pain real? It's very real. And it's not surprising though. It's not surprising because 2021 was the 11th year of the longest bull run the world has ever seen. And if that happens, people forget that bad times can come. And all of us forgot that for a while. And when that happens, you start making investments at valuations that you can't justify later to yourself. And all of us have things in our portfolio that will be hard to justify. Some people have a lot of them, some have few of them, depending on who you are, who you speak to. Everybody says that others' portfolios have more pain, mine is less, but everyone has real pain. And if somebody says, I don't have any pain in my portfolio, you should say, I don't believe you. Now, I think globally this was a problem. In India, the problem happened was typically India has been a slow-moving venture market. And I'm speaking specifically about the venture market, not the large PE deals. It's a slow-moving venture market. Things move slowly. But in 21, because there was so much capital available, we pushed it to become a fast-moving venture market. You cannot artificially accelerate, create markets by pushing capital into companies, giving them a whole lot more capital than they need, deserve, require for the future. And that's what we all collectively did as an ecosystem in 2021. I was recently doing a meeting with an LP, and he asked me a question which set me thinking. The question was, in the last 20 years of the venture market in India, how many companies have you seen that have a gross margin of $500 million? I said, gross margin of 500, why do you ask that? He said, for a company to have a valuation of 5 billion, in my opinion, a gross margin of $500 million is important. I looked hard, thought hard, and said none. I may be wrong, I couldn't think of anything. Then he said, do you see any company on that path yet over the next few years? I thought hard and said, maybe one or two. And then the harsh realization that if that is the valuation of a startup, if 5 billion is the peak valuation someone can get justified by real numbers, then how many companies are we pushing in $1 billion to get to some high number? And we have companies valued at 22, 17, 15, 12, 9, 8, 7, all numbers. But none of them have anywhere close to $500 million of gross margins. So that, when you look back in retrospect and think about this, it's so simple. What were we all smoking? And we'll again smoke 10 years later. So it's not that it's not happened before. We all sit in a room and say, oh, you know, that fund is given term sheet. Let's also do something. My God, we're losing all deals. Let's be more aggressive. I think this time it's different. And we'll come back. So that's what we've all done. And therefore the pain is very real because we have to look back and introspect. And what happens is in times like these, you overcorrect. Because you've made so many mistakes that you go into a shell. You forget that there may be real value at the table now. Either you tending to your problems or you don't have the guts to put more money because you're feeling the pain. And that leads to more mistakes. And that's a cycle that we all go through. The ones who forget the pain and somehow engage in more constructive deal making, if you will, at the valuation that Vikram said are making a lot more sense today, they'll do well over the next few years. They will cover up for some of the mistakes. Those who stay in the shell will struggle. And it depends on how stable your franchise is, how good your LPs are, and so on and so forth. And many of those things matter. And what's your track record prior to that? And this just also goes beyond from investors to founders. We've made many mistakes. Founders have made many mistakes as well. So we should not just blame it all on investors. Founders also got carried away. They also started saying things like what you said, Gautam, which is, I think the valuation is this, or I feel the valuation is this, and they got it and got away with it. And after that, they also start becoming Elon Musk and so on and so forth. Everybody thinks that I'm the next dude in India and I can give gyan on Twitter and I can tell the world how to build a business because your business is 100 crores of revenues and 400 crores of losses and you're worth $1 billion. That makes no sense. So those are things that we forgot and we made all of them heroes. I think that's the culture that we have to change and we have to get down to the basics and say, hey, world is different, pain is real, let's do businesses that make sense and get disciplined. If we can do that, I think the next 10 years are really, really good for India because a lot has changed from the last downturn. We are in a much better place today, but we have to be well behaved. So that's, in summary, what I think has happened over the last 24 months.
Thank you.
Very good remarks indeed, and thank you. Quite comprehensive. So my view is somewhere in between. Yes, there is pain, but the pain is more related to, as Abhay put it, on not being able to sustain the valuations that you got the last time round, right? So the big party has ended. 2021 was the big party, and maybe there was a party building up for a long, long time. So this is the next morning after the party, and everyone's hungover, and the head is heavy, and you say, oh my God, this sucks, and I don't know how long this pain will last. But the truth is that if you steer away from what everyone had gotten used to, which is these high valuations, even with the performance lagging, and you look at fundamentals, I think there is still important problems that India needs to solve. There are still good founders in the country, and a lot of seasoned founders in the last decade have been created. The original batch of successful, quote-unquote, successful startups has created a new crop of entrepreneurs who know how to build businesses. And there is domestic demand, and the fundamentals of the country are still intact. So I think if we moved away from, okay, let's celebrate the unicorns, let's celebrate fundraisers, and start celebrating business building, business creation, that's what this next phase should be about. And the good news in the, despite this hangover is that in the last 18 to 24 months, people raised capital. So a lot of startups, putting aside whether their valuation is justified or not, they have cash. And if they can manage through an 18-24 month period of not needing to raise, they should be okay. And if they can be humble about the valuations they now seek, and I'm having different conversations with founders now than I had 18 months ago. I am surprised when a founder tells me, you know what, I'll be okay with a flat round, even before I ask. Or saying that, we can do a convertible because I understand that you may not buy into the valuation I had in the last round. So if reality and realism sets in, we're not in a bad place. We can still create sound businesses and this time round not repeat the errors of the past. So I continue to be bullish for the future, but yes, the pain is there and disciplines are being taken and people are in bed waiting for it to pass.
Thank you, Ruchira. And while we have heard all the three panelists talking about specifically how the VC part is going through in the last 12 months, let me draw some parallel in terms of how the pain per se or the macro trends, because we are just talking about the broad macro also. But I like what Abhay said, that we actually keep making the same mistakes, whether it's a public market or the private market. And to that extent, yes, I think 2020, when the COVID hit us, if I draw a parallel, the public market again reacted into a very, very negative way, as if the world is going to come into an end. And maybe some of them might have thought genuinely that, we really don't know what would happen. But the reaction was so negative. And then as the floodgate got opened in terms of zero interest or almost zero interest and how the money started flowing in, that not only brought these things into the private side, but even on the public side also we saw that the valuations actually become quite atrocious, if I may say. But one good thing has happened, which is a good for the private equity or a VC part, more importantly VC framework. As a capital market banker, I have been seeing this demand from the companies from 2010, 11, 12, that companies should be allowed to go and list US directly without getting listing into the India. And that thing is still going through its own motions. But 2021 actually brought out the fact that many of the new age or tech companies not making profits also can get listed in India also. And they got valuations which we can debate in hindsight, but at that point of time they got the valuation which they were hoping for, they were looking for, and some of them performed, some of them could not. But fact of the matter is here that when the companies are thinking about it, the VC companies are thinking about it, the next 18, 24 months, VCs are thinking about it. I think positive side is that they now know that the Indian market and the Indian investors are becoming deep on that part. And if the business model is such that ultimately you can have the visibility of profits at some point of time, you don't have to wait for profit to come. But that part is Indian markets have accepted. I think on a pain part, yes, right now, if I see that IPOs are still happening, but the new age tech companies are finding it that much more difficult to get the IPO done. In 2021, it was an easy dialogue with the investors that companies are not making profit, but they will make profit. Today, investors are not, at least the public market investors are not ready to listen that anything where the companies are not even seeing the visibility of the profit. So that way, there is some distance again that these companies have to do that. But on a broader part, I think I'll subscribe to this that another 10 years or so, they're actually going to be good for these companies, even from the public market perspective also.
Interesting. Touching upon what Abhay spoke about, that we're going to make similar mistakes in another 10 years. Is the upcycle, down cycle this time around any different from the previous rounds? Don't forget, we've had a 2021 which we have never seen before. So, is any parallel to be drawn between any of these up cycles, down cycles, and the learnings that we can take away from that? I'll come back to the key learnings, which Ruchira was talking about, that there has been some realization with the promoters, and we'll talk about sustainability of these companies, but any parallels between the up cycle, down cycles?
Let me share some thoughts and then I'll pass this along. I think, and I said this, earlier as well, I think the way COVID hit the founders was pretty severe. And given what's happening right now, people tend to forget what happened then. Entire business models became irrelevant, right? And I can give you examples. Ride sharing. We were in the midst of evaluating a couple of companies in that space, and suddenly that use case disappeared because people, the whole office commute thing stopped. People for working from home. And if you don't have the use case for 24 months, now things are going back, but it's really severe on the startup, and it's not possible for them to survive that. Similarly, so, retail outlets, shops, curfews, right? Things were completely shut down. Logistics broke down. State borders were shut. So the way I think COVID hit the founders, which was completely as a surprise and unexpectedly, was, I think, a bigger hit than what is being faced today. And it forced a lot of people to grow up and say, okay, now I need to cut cost. I need to rationalize workforce. Management teams took salary haircuts, founders took salary haircuts, and a lot of investors said, I'm going to not do new deals, I'm going to just help my own portfolio survive. Let's do bridge rounds. So I think on the back of what we saw in 2021, there is this muscle has developed on how do you react when something bad happens, and that has stood them in good stead now. And because this came on the back of several of those cost structure corrections, we are better placed right now. So this is just the short term of the COVID and issue and now. I'll pass on to my panelists for other thoughts.
On similarities and dissimilarities of the previous cycles, I think all up cycles are similar. We all get carried away, and we all learn at the end of it. So there's not much difference between one up cycle and another. Some can last longer than the others, and the problem with the last one was it lasted very long, and therefore we got carried away for far too long and made more mistakes. I think the more important thing is to focus on what are the dissimilarities this time around. Why is this time different from last time? And I'll speak more specifically for India. I think there are 3 or 4 very fundamental differences this time. First, from a funds point of view, all of the venture funds in India today, compared to, let's say, 2008-9, when the down cycle hit in a big way, every fund that I know of today has more capital than they've ever had before. So every fund is well capitalized. They have more what we call in our jargon dry powder. That's a big difference, and that gives you confidence that I don't have to be on the road again to fundraise. That's one. Second, in 2008-9, when the down cycle hit in a big way, most investors had no clue of what to do because there was no investing experience in India. The most experienced investors were people who had 3, 4, 5 years of experience and had made more mistakes than good things, and therefore there was very little that they knew. There were a few exceptions, but broadly speaking, it was a new investing class that we had in India. Now that all of us have been doing this for the last 10 to 15 years, I think investors have learned. So they will adjust and readjust very quickly this time around. And they have capital, they know what to do. It's just that it's about executing. Knowing is easier than executing, but hopefully we'll do a better job. And most importantly, and that's something we should not ignore, the crop of founders that we have now in 2022 versus what we had in 2008, it is a world of difference. A much better class of overall founders as an aggregate. I'm not comparing one versus the other. Sachin and Binny started in 2008, so let's not take anything away from them. But today, the number of the 25-year-olds as well as the 45-year-olds and more who've started companies and are building good businesses is far, far higher than what it was in 2008. And as a result of all three, experienced fund managers, much better quality founders, and a lot more so-called dry powder with all the funds, I do feel that we have a chance, a unique chance to make a much better outcome of the next 10 years because of this downturn with the added advantage the world is looking at us, looking at India, saying, hey, this is the next big thing. And we talk to any large pocket of capital in the world, they are saying, how can we push 1, 2, 3% of our entire portfolio from China to India? And if that happens, and it will happen over the next few years, we will have a lot more capital, a lot of great entrepreneurs, and hopefully a few good investors to make it all real.
Yeah, in fact, totally agree with what Abhay has said. In fact, I think the macros also have changed quite substantially, right? So, of course, the markets have changed. And if you look at India as a market, the entrepreneurs have become very mature. Investors have become very mature. The regulators have become very mature. I started IvyCap in 2011. We started investing in 2013. So there were just about 6, 7 funds that started in India around that time. And if you look at how many funds started in India last year, there's a sea of difference. And we look at the number of angel networks that have come up everywhere, right? So the definition of Series A has changed quite substantially, right? So, we did Purple in 2015 with a 15 crore investment with 30% stake in the company at that time. Try doing a Series A with that kind of investment today. So there's a pre-Series A, there is a, multiple seed rounds. So I think, as Abhay said, there's a lot more capital out there, which is actually waiting to be deployed. At the same time, the number of mature and the quality entrepreneurs has substantially increased. And the good part is that the regulators are now also understanding this space much better. Therefore, the policies and the frameworks which are coming from taxation perspective, from SEBI perspective, even from RBI perspective, we are seeing a lot of kind of receptive behavior. People are willing to consider making changes, and I think there are lots of positive changes happening in the country. So I think even though there is a little bit of slowdown in terms of the overall market from a venture capital investing perspective, I think the numbers as we saw there, if you compare the venture capital, 9 months, while it looks smaller than the overall deployment last year, I think the overall full year deployment will be much higher this year. So I think overall, I think things are looking good from our perspective, from venture capital perspective.
There's an interesting perspective that you all brought out. The maturity of the investors and the market, leave aside the entrepreneurs. There is one more limb I'd like to add to this maturity journey. Legal documents being written as what they were supposed to be written as, equity documents, not debt masquerading as equity. Back in the day, it was so common for investors to write a put and then force the hand of the promoter. Eventually, it used to lead to litigation and massive amount of loss of focus, leave aside burning of hearts and what you have. The investors have become far more mature, and this is from one of the strategic investors that we learned the other day, that do not try and take away everything from the table. Instead, make them stronger and stronger and see the network effect, how it's going to play out. In the last decade or so, I've seen that happening so often, which was not the primary aim initially. It used to be, okay, how much is the IRR? What are the ways we can force the hand of the promoter? So the going in position used to be, okay, how we getting our money out? People have far more patience now. They understand when an event is unforeseen and when the promoter is actually not doing his job. So that has, to my mind at least, really helped create this confidence. And now people are working more and more as teams rather than I'm an investor and you're a promoter. Lessons from this previous downturn, we've already spoken about cost cutting. Anything else that will set the Indian entrepreneurs, it'll keep them in good stead in the next 12 to 18 months?
I think the one thing that didn't get mentioned and actually fits well with your question of what will put them in a good spot for the next 12 to 18 months when we're contrasting 2008 and this time around, a lot of the businesses that we were seeing back then were, this has worked in the US, let's try it for India. This has worked in China, let's try it for India. It was trying to replicate what had worked in other markets. Something shifted after that correction where, and actually that phase went on all the way, I want to say, till 2015. I kept seeing, okay, this is a lookalike of this. And investors were asking that question, what does this look like? And the founder was giving that narrative. But around 2016 is when we said, okay, you know what? I don't want to hear the lookalike of this parallel in China or this parallel in the US. What is the India-specific problem you're solving? And founders said, okay, this is the India-specific problem, and here is the business I've created around it. And then that narrative shifted to the next level, where you say, what is the problem you're solving that can be solved for India and then exported to the world? And what is very heartening to see is now India is able to build solutions for the world from India frugally and export it. So we are the exporter of frugal innovation, which puts us in very good stead. Because what's saving us this time around, we are sitting on fat forex reserves. So every currency across the world is in pressure, but we have seen some depreciation, but not so bad. Because we were able to provide stuff to the world that the world was willing to pay us for. And that, on the innovation space, is what we would call for today. Innovation out of India for the world for the next 12, not just 12 to 18 months, for the foreseeable future.
I think the first thing I would say is for founders is don't pay too much importance to what investors are telling you. Because investors do not know your business as well as you do. And they may help you give a very high-level guidance on what not to do, what the guardrails of the business should be, because they have a wider perspective across many businesses. But don't start depending on investors on saying, hey, let's do this and let's do that, because investors can come with lots of ideas, and if founders start listening to all of that and experimenting with all of that, they waste a lot of time. So focus on your business. Investors have backed you for your business knowledge, acumen, enthusiasm, energy. Use that to build the business your way versus listening to investors, which brings the other angle that does not have too many investors, because the different investors have different priorities, timelines, views on life, and then your job should not become managing investors. You are managing a business. Investors give you capital. Manage the business, and if you have too many investors, it's a lot of pain managing them. So have fewer investors, do not listen a whole lot to them, and I think the most important thing which is coming out of 2021 is raise capital that you need to raise. I think what happened in 2021 was the round started with $50 million of raise and became 150 or 200 because capital was available. And capital was available because everybody wanted to put money into the so-called good companies. The so-called good companies got so much capital that they did not know what to do with it. And therefore, they started doing all kinds of crazy things. And if you hear that a company has $450 million of cash in the bank and they're burning only $5 million a month, neither of that is good. 5 million burn is bad, but it's not only, it's $5 million. And you have 450 in cash, why? Who's given you $450 million for what? So those are questions that they have to think themselves. Investors like logos on their walls. If you enter investors' office, there are lots of logos. Everyone wants a Swiggy, a Zomato, a Nykaa, etc., right? You want that. But don't take my money just because I want my logo and because I'm giving it to any valuation. That doesn't matter. It will hurt you. So the founders should be disciplined about how much they raise. The best companies usually do not raise tons of capital. The famous saying is that if you give less water, the roots go deeper and are stronger. The trees are stronger that are built with less water. And that's true for most companies. There's some businesses and very few that need tons of water, of capital, but they are very few. Most of them can be built with small amount of capital, and that's what founders should do. And the investor pressure and questions lead founders to do wrong things. Just an example, at Sequoia, we used to ask the question to many founders, how many engineers do you have? And that's a question to ask to figure out what's the tech element of the business. how technology intensive is the business? Is there defensibility in this business? Now founders take it the wrong way and they start saying, you know what, I have 100 engineers. Now what are they doing is more important than how many engineers do you have. WhatsApp was built with 26 engineers. And India, I kid you not, in Bangalore there'll be at least 10 companies who have more than 300 engineers. What are they building? They should ask themselves. So that is, do not get carried away by what investors are asking you, expecting of you, telling you. Manage your business, manage it with less capital, with smaller teams, and that's the element of frugality that we all have discussed in the past. But I think it is lots to learn from what's come in the last 1 year. But most important, build it your way, build with less capital.
I think Abhay has said most of it, but I'll look at it from seed to Series A perspective. So, and I think what we've seen is, there is a wave of investments in certain sectors over time. So you'll see there was a wave for e-commerce, there was a wave for, and purely from seed to Series A perspective. There was a wave for fintech, there was a wave for edtech, right? So we've seen, from very early to growth stage phase perspective, I think there's a wave happening for the new age technologies, for space tech. We were talking about that, for AI, ML kind of technologies, and we are seeing some of those technologies now coming in newer ways. And I think if you're an entrepreneur who's actually looking to set up something new, or you're already at very early stages, I think of course there are lots of disruptions possible in lots of other sectors which are already mature to some extent. But I think if you're an entrepreneur at early stages and looking for disruption in newer businesses, I think there are newer opportunities which are building up, which I think one can look at, which is something which one should think about. And technology, of course, will play a huge role. There's a lot of debate around crypto, but I think there is, while crypto went down quite substantially, I think we are seeing some signs of coming back. But of course, in India, nobody's paying attention to that right now. But I think globally, I mean, there's some investments happening there now. Blockchain, of course. So some of these sectors, I think, probably need to be given some attention to. And the other point, which I think Abhay was rightly said, that some of these investors focus on building logos. I think in our case, for example, we didn't have a unicorn in our portfolio until Purple turned unicorn very recently. And we don't focus on unicorns for various reasons, because our objective is to create dragons. So Dragon is a company which creates more than 1x return of the entire fund. And the idea is about value creation rather than valuation. So I think therefore, the right thing, as Abhay said, I think you focus on your fundamentals. If you focus on your business, don't listen too much about what investors are saying or investors are asking, because investors have different objectives. And I think stay sane in this market, stay focused on your business.
That's very insightful. One question I specifically have for you, the Zomato and Paytm IPO and the world after that, how has it shaped deal making, exits discussions, as well as even capital raise for that matter? Because suddenly the exit horizon has expanded because IPOs are no more a safe place to go to.
Interesting. So, we were earlier discussing about how this downturn versus the last downturn, what are the difference on that part. So before answering your specific question, let me put some context to that. 2008-9, when the public market downturn happened in India, at that point of time, the reaction was extremely sharp towards the Indian market. Indian markets lost a lot. And superimposing the IPO part, at that point of time, any Indian company which used to do the IPO, 70 to 80% of the demand used to come from the foreign institutional investors. Fast forward it now, 2021-22. Again, we have seen that 20 was COVID impacted, so everything was a sharp reaction. But 21 was a good year for almost all the global markets. But the 22 has not been like that. But the fact of the matter is that, leave aside for a minute Paytm, Zomato, Car Dekho situations. But if we're sitting in November of 2022, if you look back, and see, Nasdaq is down almost 33% YTD. Dow Jones is down almost 22%. India Nifty is still 4% up. And that, out of a 10 months, 8 months the FII flow has been negative for India. If this situation would have happened in 2008-9, then it would have been a disaster for the Indian markets. So something fundamentally has got changed. And that has got changed as partially, as Abhay alluded earlier, for the VC funds, that the funds have more money now, the fund managers have become more mature. And the same thing have happened from the public market perspective also. The money which is going to get invested in India of Indian people has grown manifold there. And that has created a balancing part there. Consider it that every month, if the Indian fund managers in the public market are getting almost 10 to 12,000 crores as a SIP money, which is almost around a $1.5 billion, whichever way exchange rate you take. So there's a decent amount of money for them to keep putting on the work. And then if you have to put that money at the work, then the question comes up is that where do they put that money? They have their existing investment companies, but they all keep scouting for various different avenues. To that extent, interesting phenomena is happening is that many of the public market investors also now have a pool of capital where they are happy to come as a pre-IPO. They also were scouting for the same opportunities, not at a Series A, Series B level and all, but anyone who is beyond Series D and thinking about an IPO visibility in the next 18 to 36 months, they were very happy to put some part of the money. But reality here is now that public market investors have seen that. They have now got into this motion of seeing the value creation which is happening at the private side also. And some of those instances they have got to participate. Now the experience have been mixed. The Zomato as a stock got priced at 76, went up to 140, 150. Some of the people, the IPO investors at least have the option to exit out, went back to almost 40 levels, again at 65. So it's a public market issues which people deal with. I think the more issue comes up is when they have to deal with Paytm situations there or so, where there's just one side downfall. But I would say that as more and more maturity would come at the end of the founders and the companies also on the new age part, and people will become more mature to see how to value this. You know, they are not profitable companies. Most of them are not profitable companies. And the public market investors, they usually go onto the time-tested parameters of whether it is a EV EBITDA, whether it is a price to earning. And for them, it becomes difficult sometimes to really understand and appreciate that. But what is happening is that people have now seen that you don't have to go to US market to get listed. And leave aside the regulatory part now, at least on the marketing part also it has been established. You are seeing that the markets, Indian markets are being more robust. In fact, I mean, as we are speaking in this week, there are like 6 or 7 IPOs which are going to hit the market there. And most of them are expected to do well. And I was just before coming, I was seeing the anchor investors for a company like Medanta Hospital, which is actually primarily it's a 1-unit hospital, but who and who of our public market investors have come on that. So I remain quite hopeful and optimistic that public market will remain a viable and a very, very credible option for the investors to think about. But I would go with the assertion that in the next 18 to 24 months, the companies and the founders need to do more work. And I think when the actual IPO time comes up, and it's an ecosystem, I would not put a blame only on the founders or the investors, even the bankers also, when we go and pitch also, just to sometime get the mandates, and all the bankers also become very, very aggressive that they will be able to get X or Y or Z. And when you have to actually deliver, then that the problem comes up. So it's an ecosystem which we keep learning on that. But the heartening point is that the trend is positive. Whether it is in terms of more and more investors getting interested in this part, whether the amount which they are having, I mean the domestic mutual funds, insurance companies have now that part of our money, and which is partially responsible. That's how you're seeing that, I mean, even after a 10 month of FI net flow, point to point, the index, whether it's a Nifty or a Sensex, are giving positive return. Now that is not covering up that, I mean, there are mid-cap companies, there are smaller companies which have actually seen quite a bunch of that and all. So we're not glossing it over. Don't take it in that everything is hunky-dory on that part. But on a broader trends perspective, that's a good sign that we would see more and more public market participation also on these companies as they become more mature.
Thank you. That there's a lot of ray of hope there for exits at least. I'll now open the floor for questions.
Hi, can you hear me? Vikram, my question is to you. You mentioned that most of your capital is domestic. So my question really is, if a lot of these SaaS companies specifically, right? They are most of them are Delaware corporate. They basically built in India but sold to US and the rest of the market. Now these transfer from I'm basically an angel investor, so now the LRS to foreign entities have become extremely difficult, especially for safe notes and convertibles. I just want to understand from your perspective, being fully domestic capital, how difficult it is to invest in essentially Indian companies, but they're Delaware Corp for other reasons.
That's a very good question, actually. In fact, we do face that problem many times, especially because we have quite a few insurance companies as our investors, and IRDA doesn't allow insurance companies funded funds to invest outside of India. So effectively, we can only invest in India, right? So, but interestingly, we have quite a few companies in our portfolio, SaaS companies, who are actually Indian companies, but actually mostly US revenues, US dollar revenues. So what we do, actually, in fact, there is always this debate. Even if we invested in the Indian company, the follow-on rounds will happen, or more likely to happen through a US investor, right? So there's this question always that after we've invested, should the company go and, set up their holding structure in the US? So that debate is there. But I think ultimately entrepreneurs also want to raise capital from the investors they are comfortable with. If they're Indian entrepreneurs, they're more comfortable with Indian investors, right? So, even if entrepreneurs sitting in the US, we have quite a few companies actually which are founders are sitting in the US, but they've raised capital from us. So they are willing to set up their holding structures in India, in order to raise capital from us. So I think there is a little bit of the choice people have to make. But I think people like Gautam and I think others, Trilegal, they also understand the creative structuring aspects of, how to find the right way to structure these things.
You're saying it's possible to invest domestic capital?
It's possible. It's possible.
There will be this round-tripping issue, right?
No, there's no round-tripping. There's no round-tripping.
Two ways in which you can do it. One, which is you go through RBI approval and you are able to invest. There's a process. Right now, we have reached the limit of the annual amount because many people were making those investments, and many applications are pending with the RBI for increasing the limit. And SEBI has been trying hard with the RBI to increase that limit. It's stuck because of the depreciation of the rupee. It's not being approved because you don't want more rupees to go outside. But it will open up, and therefore you can make that investment. If you want to go around it, the only other way is to create a parallel structure in India, a subsidiary, which has a services agreement with the parent company, and you mirror all the economic rights in the subsidiary. So people have done those structures as well. That works, except that you have to sell all your shares when the holding company goes public, because the use of proceeds has to be to buy out the shares from the subsidiary, because there's no other way of getting an exit.
One more question.
So basically, about the shadow investments, if suppose I have made an investment in US and I have been received reciprocating shares of the Indian entity of a particular company, whether this is perfectly legally valid or there are some challenges with regard to the shadow investments which investors are doing upon in the Indian companies, whereas there is a shadow investments with regard to the valuations of the US companies been made. But the shares being granted to the investors out of the Indian company, and reciprocating any upward or downside is being fulfilled later on. So So I just want to keep that question to the forum itself.
It is probably not the focus of the discussion, and maybe Gautam should take it, but it is legit. People have done that and have found exits as well. So there's nothing wrong legally with it. There are some drawbacks, but it's a longer discussion.
Look, I can think of at least 10 big names which have deployed this. The regulators are in the know of it. They have not red flagged it. We, per se, do not foresee it being red flagged, at least up until something goes wrong which nobody is foreseen.
I personally have made investments through the shadow investment for sure, but are there challenges with regard to taxation? I personally feel so, that there are challenges with regard to taxations.
Let me simplify this and try and answer this from a different perspective. Look, phantom stock, to give a simpler example, there used to be a debate that whether it's a derivative or not and whether it should be treated as a derivative by the regulators. Truth of the matter is it's still very much prevalent. Similar to what is happening here, right? You're just mirroring the two structures at two different stages. Whether one is taking color from the other and therefore the primary investment becomes a derivative trade, this discussion can get really technical on those levels, right?
But the underlying assets is totally different for both entities. The phantom is totally different, and here, when you talk about the stocks, the underlying assets is completely not comparable.
But you are mirroring rights, and where do you affect the rights eventually?
Rise is for a particular territory, whereas the holding company rise is for the globe.
So, once again, like I said, these debates can get technical. That's your view, right? To answer your question simply, so far, no red flags.
And just one more question, if the House allows. When we talk about the round-tripping investments, one of my client, not to name the forum, one of the forum itself has mentioned about the investments. Suppose I am having an entity in India and I made an holding company in Singapore, and there are 3 investors, 2 resident and 1 non-resident, 2 non-resident, 1 resident. The residents being investing into Singapore, coming back to India fund. Whether he can directly make investment into Singapore entity, holding entity, coming back to the Indian entity, which is a which is subsidiary of the Singapore entity, or they need to create a structure of LLP, and then through that LLP, the funds can move to Singapore and come back to India. Your legal views over the same.
Can you send across a written?
Any other questions to the panel? Are you there?
Hi, good morning. My name is Sandeep. Perhaps I'm the only one not in a suit here, so I'm a founder, not on the investor side. My question to the panel is, so we are a multi-brand EV platform, we are omni-channel EV platform, and we are trying to solve the problem. There are so many EV brands, we are trying to solve the problem of choice, giving consumers choice under one roof, expertise, and helping them ownership, different models. Now, this is a little disruptive, and it's not there anywhere else in the world, right? And it comes back to your point, where when we go and pitch this, there's this question, okay, where else has a multi-brand, platform been successful anywhere else in the world, right? So this is an India-specific thing, because India is a two-wheeler market, right? And with the EV rising so drastically, we are bringing EVs under one roof, multiple brands, giving people choice, education, ease of ownership, subscription models, etc. Right? How do you see us, answering that question when potential investors ask us that?
A very brief response. I think numbers speak louder than words. So yes, investors used to say, "Give me the parallel," and they might still do it, right? But it's okay to say this is an India-specific problem, and I'm not talking about your business per se, because I have only understood 10 seconds of your business proposition. I'm saying generally, when an investor asks you, and goes back to what Abhay was saying, how seriously are you taking the investor? You believe in what you're creating, and the business proposition there, it's okay to tell the investor, well, I won't be able to give you parallels because this is specific to India. But once I can prove it out in India, maybe it crops up in Indonesia, it crops up in Philippines, and you'll see lookalikes in other markets, because India, as I was saying earlier, is an exporter of innovation to the rest of the world. So, and then the next question will be, okay, if it's an India-specific problem, show me that it works, and that's where numbers speak louder than words. So show the numbers, and if you can show, investors learn from founders. I learn from founders all the time. So if you can show us that it works, we will be open to listening to that.
Thank you.
Yeah, hi. Rishi Aswani from Houlihan Loki. Thanks to the panel for their views, very insightful. Just a question, I think we heard a lot of great perspectives today on the public markets, how it's been flat in India since the start of the year, as well as the sell-off in some of the tech names. And then of course in the private markets from Vikram about, I guess, how some Series Bs are happening at the Series A prices from last year. So my question to you is, I'm just curious how credible these flat rounds are in the private markets, because it doesn't seem like too many people are blinking and taking flat rounds, and I understand flat rounds are generally very negative from attracting talent and from, for the investors as well. Just want to get your different perspectives on that. Thanks.
I think flat is the new up. If you get a flat round, you should be very happy in most cases. It's not happened yet, but there are many discussions where you'll see that many down rounds will happen. It's inevitable. How long can current investors do bridge and bridge to God knows where? All of that, those conversations are happening. So it is real, it will happen.
Yeah.
So,
it is seeming a bit too good to be true. And that's why I guess the question, because the flat rounds have started overseas, lagging the public markets meltdown over there. But here we don't have a general public market meltdown, and I guess we're questioning whether public markets are flat or whether the right benchmark is the sell-off in tech and loss-making.
So let me give you an example from last year. There was a SaaS company that came to us for investment, revenues of $1 million, asked for a valuation of $100 million. No, you're laughing now. We didn't laugh. We gave them a term sheet. And luckily, somebody gave them a better term sheet. And then they told us, can you match that term sheet? We said, how much better is that? They said, only 20% more. We thought hard for a week. We said, okay, we'll match it. The guy said, no, matching is not good enough. That guy is bringing some US partner to come and sit on the board. So you have to beat it by at least some more number. And that's when we said, hey, it's not going to work. Now, that company, same company, and we got lucky therefore, and the same company now has moved from 1 million to 2.5 million of revenue. And they projected 5, but they've moved to 2.5. Now they come to market, what do you think they'll get? Huh? So they should be very happy today if they get 25.
Yeah, that's a 10x multiple on SaaS, which is rich.
Which no one is getting.
Which is rich.
Yeah, so they should be very happy with that. There are numbers of, now the US meltdown has happened. Take the example of, I shouldn't take names. There is a company in the US which is the market leader, which is 5 times the Indian company size. Their market is 750. The Indian company got valued at 600 last year. What is the next round going to happen? Who's going to give them money at anywhere close to the last value? They can drag on for 2, 3, 4 years, but they have to do a down round. There's no choice.
So it sounds like the last financing round in the prior regime is to be questioned.
Absolutely.
Thanks.
And I'll just add, because you mentioned about the public market part, but the public market, again, the flat public market in India is no sign that the IPOs can be done at all sort of valuations there or so. So much so that you must say that, and without taking any names, the IPOs which are right now happening also, when they started, the expectations where they were and where they are getting done, there's at least a 20 to 25 to 30% drop in their numbers also. So that's a hard reality. While the markets have been good, but investors are becoming more and more asking about it and all. And leave aside, there's a separate discussion which we can have, that how for the newish companies, now SEBI is becoming more investigative on that part there.
Yeah, absolutely. Just maybe one last question on that. Would you agree that there's a differs between the IPO market and the public markets?
Yes, to that extent that I mean in the public market, when the investors are thinking about it, they already have the track record of the companies. In an IPO market, it's always a price discovery. And a price discovery means that if the investor who already has 50 companies in his portfolio and he's finding some of them at an attractive valuations at this point of time, he might want to put double down there. And IPOs typically, you will have to make slightly more attractive for investors to come and start taking the positions. If you can see that and all, many of the IPOs, after the trading, they trade up. The good IPOs also have traded up. So much so that I mean, even on the retailing side or a consumer side, the companies which have got priced at almost 55, 80, 60 times price to earnings, they are today trading at 80 times. But at the IPO time, they couldn't have got it that same number.
Thank you. Thanks very much.
But having done this for long enough, there are no rules in this game. For example, between 2010 and 2020, we have a lot of investment banker friends and mutual fund managers who are friends, and they'd always come and tell us, "Kya karte ho tum log? How can you value this company like this? Isme kya dikh raha hai tumko?" Always through 2010 to 20. In 21, when the IPO started happening, we got a chance to give them back. "Tumko kya dikh raha hai isme?" And all of them said, "We have to participate because this is the new future." And going back, Vikas and I were part of an IPO in 2007, a big IPO, where all the investment bankers in all their wisdom came up and told the company your value should be $7 to $8 billion. The company said, "We will take nothing less than $25 billion. We think this is our value," as you said. We said, "Okay, let's talk to our global experts and see if that number is justified." In an hour, in a global call, no call happened, but we said we did a call with our global experts, and the value changed from 8 to 25 in 1 hour. And the IPO got done at $25 billion, traded up to $40 billion, up to $40 billion. Today the company is still, after 15 years, valued at maybe $7, $8 billion. So the capital, what we say, what happens, there's not much sanctity to all of this. Enough goes on at the back room. Few people sit down and decide, and that's the view, and that's the right number. A big mutual fund, a large institutional investor says, "I think Pharmacy is worth 10 billion. It's worth 10 billion. That's it. You can't argue with that." And tomorrow, 2 years later, somebody says, "I think it's worth $2 billion. It's $2 billion. Not much has changed, but so therefore, what I'm saying is many of these things go through many ups and downs. We may have a view, but we may be completely wrong. And that's what we've seen over the years. So don't take us all very seriously. Focus on the numbers of the companies. The numbers are good, you should be investors. If they're not good, okay.
This question is to Vikram. Vikram, you mentioned that dragons are now more important than unicorns. Could you throw some more light on what's the dragon?
So we recently had our annual IvyCap day. Our theme was Thunder of Dragons, because I think, in fact, I was in a panel about almost a year ago when, in a panel like this, there were other VCs, and somebody said that, you created India's first dragon in your portfolio. Even I didn't know what a dragon was at that time. So, and that's when they told me that a dragon is actually a company in your portfolio which gives you more than 1x return of the entire fund. So if your fund is, let's say 500 crores, you invested 20 crores in a company, the company gives you 600 crores as an outcome. So that becomes a dragon in your portfolio. So that's how I also learned in that process.
Thank you. That's the learning of this panel also.
And this is cash return, not on paper. This is actual cash return. That's important.
Thanks for clarifying to say.
And that reminds me of somebody speaking about why a unicorn is called unicorn. It's just magical numbers. They don't exist. So.
Hi, this is Bala Subramaniam from Netrika. I heard the panel talk about the changing maturities of both the investors and the co-founders in the journey of the whole investment journey. So just curious in terms of, are there more rigorous due diligence on the founders or on the business plans or on the supply chains, which is sometimes very critical for the business to actually, stand on its feet? are there budgets for that? I mean, do you actually do that, or
There are lots of budget. There's no time, or there was no time in 2021. The budgets were huge. I mean, you get 2% on large numbers of funds. Those are all for all this stuff. And no, actually, you can use more than that for diligence. So there's lots. Budget is not the problem. The problem is time. Last year, we all short on time because you're doing so many investments that you didn't have time to do diligence, didn't have time to know the founders well. And that's where problems happen. And you don't care what the founder is doing because you've moved on to the next investment. You're not attending board meetings. You're not spending time with the companies. You're not helping in whatever, recruiting, et cetera, et cetera, et cetera. And therefore, that causes issues.
right. So you think that's going to change now? I mean,
It's changed. It's changed. We have a lot of time. You can see here. You can keep asking us questions.
Superb.
You know, the other point there is, like he says, we do have a lot of time, and because the humility level has shifted, right? And we were talking, you know, you asked about the down round. You know, last month there was a founder who I've actually been tracking for a while, and I wasn't quite convinced the valuation was too high. They came back to me and said, you know, my last round was at 100 million. I'm now piecing together a round at 20 million. Okay? 20 million. And the way, Ruchira, I don't need the money now. I want you to just chat with us and be prepared where we can come back to you in the next round. So I said, yeah, that's fine. In fact, I told the team, I respect him for having come down to 20 and wanting to re-engage. Let's track this for 6 months, see how it does. So there is a lot more humility, and yes, rounds are taking longer. I think we're in a good space now because the deals that we will do today will be better priced. When I say today, I mean the next 18 months, better priced. So investors are in a good place right now because this vintage will probably give you very good returns. And I think founders, if you're building quality assets, are in a good position because there is a flight to quality and there is dry powder. You know, as the venture intelligence data shows, in the last 3 years, over 100 funds have closed with $12 billion of capital. All of that will be deployed in their investment period, which is give or take 4 or 5 years, right? So in that time, if you're a quality founder, and this flight to quality will help you raise good money and build a good business. So I think it's the best period for both investors and founders.
Hi. I'm a founder myself. I've been contemplating on this that maybe the companies which were getting funded in the last 1 to 2 years, okay, if they were to raise money in today's time, they would not get money. It could be, I'm not talking about from a valuation perspective, but I'm just saying, let's say to take an example, in financial services, platforms had value earlier, but maybe not so, and the deals that are happening are more towards people who are getting into advisory aspect. Okay, so this is one observation of mine. Second is, I see many tech entrepreneurs in tier 2, tier 3 towns who can create the tech that probably well-funded startups also have, but with a time lag because of the funding, etc., time lag of 2 to 3 months, 2 to 3 years, okay? And that's also reducing, okay? That's to say that we are comparing with well-funded startups. So from an investor's perspective, do you think the competitive moat or the time period that your funded or portfolio companies had, that's getting reduced because of the evolving tech ecosystem in the country?
I'm not quite sure we follow your question clearly.
So my question is, let's say you invested from a fund manager's perspective, you invested into a company in the last 2 years or 3 years, but the ecosystem has evolved. Maybe the platform was commanding value earlier, but now not, or the platform's on the advisory. Advisory is commanding value. So probably because I can see like not many, so many tech entrepreneurs are there across the ecosystem that platforms can be created very quickly these days. So the competitive moat of platforms have reduced. but the ecosystem is shifting. So maybe from the fund manager's perspective, how are you evaluating those companies differently now? Where would you be investing now?
I guess if I had to translate, reading across from your question across sectors, which basically what you're saying is, with the kind of activity, the ecosystem shifting across all spaces, it's not just for financial services, new business models, new technologies, does that mean because there's so much fluidity in the system, business models will not last, their moats will be weaker? Look, that's always been the case for tech, right? New technologies are around the corner, new disruptions are around the corner, and that's what it should be. And it's our job as investors to stay on top of our game, and we are always trying to learn from each other, to learn from founders, to learn from the market, and across geographies to be able to better predict what is likely to change. That's what our job is. And things will always be fluid in the tech space because the next disruption will always and should always be just around the corner. So if I've understood your question right, I think that's the way things should be.
So I think good entrepreneurs, good businesses are getting funded even in today's market, right? So, and every business is evaluated on its own merits, right? As long as the valuation is fair and realistic, I think the deals are happening, right? So irrespective of, what, whether it is advisory or platform that you're talking about, I think it's all about every investor has their own objectives in terms of returns, the number of years they'll be invested in this. So they'll evaluate from that perspective. If I invested today at this valuation, what kind of returns I'm going to get over a 5-6 year period. So if they see those returns, they'll invest. So we ourselves are doing deals today in the market. So I think there's so much dry powder in the market today. You'll probably see a lot more deals happening 4 to 5 months from now. But I think good deals are happening.
Thank you.
I guess we have run out of time unless somebody has the last question.
Hi, sir. Yeah. So what I wanted to ask is, first of all, thank you for taking out of your time and coming here. What I want to ask is that, as you said that profits are now really important for founders, right? For the companies to generate. But what if a founder is trying to solve a real problem and the business model is such that, unfortunately, the company can never be profitable? So, yeah, because just taking a minute. So basically, we are trying to make medicines accessible in rural areas. So that is part of our vision. So currently, we are doing 30-minute medicine delivery, but we feel that that is not solving a bigger problem. We may chase valuations, but not solving a real problem. But in the model where we want to solve for rural markets, the business model is such that it can never be profitable. That is what...
Somebody has to fund it, right? I mean, those losses will have to be funded.
So that's what my question is that...
No, so I think if this is never going to be profitable, it's not a venture capital or private equity investment, first of all, right? I mean, there could be grants or some other, sources of capital that might be looking to solve a social problem. If this is actually a social problem.
Impact investment, even there, they would look for sustainability, if not profitability.
Correct.
The social exchange is also on the way. That can be also part. That's specifically meant for these type of
Sir,
organizations.
but I think venture capital is needed for that because rural markets are across the country, 70%.
See, the other way to look at it is that maybe, there is a way to look at profitability from a different perspective, right? I mean, you have to find sustainability in the business, right? So how will the business become sustainable? Maybe right now the way you're looking at it is you don't see profitability in the current business model. But maybe as you evolve, there is a possibility that you can find a sustainable model. So I think one has to look at it differently and talk to maybe different people across different domains, and you'll get to know, maybe, get different ideas.
Yeah, I like your honesty. I mean, there are many companies like yours who will never be profitable, but no one has said it explicitly. But I think what Vikram said is, as the business evolves, if your business becomes large, of some scale where you have enough customers, you will find ways to monetize it better. So you should think about that and use that in your storytelling. Saying, I need X amount of money to get to this stage when my monetization will be much better to become profitable. If you start with this, that I'll never be profitable, no one will fund you. No venture capital, private equity is going to fund you. But you have to think through what's the next stage and what can I possibly do when I get a large number of consumers. And that is a sellable story. So think about that element and make that a part of your pitch.
Thank you, sir.
Hello. Last question. Last question. Can I ask? Yeah. Hi.
Go
So
ahead.
I'm the founder. So I have a company in India and Netherlands. They're 100% like Newforce India is 100% shareholding Netherlands. We are around a $15 million business. It's a bootstrap. And whatever the extra money is coming, I'm putting in a product which is going to generate, again, it's SaaS-based. It's a hyperlocal product, and also we have an enterprise resource plan product similar to Oracle NetSuite. So because of that, now I'm ending up into a working capital situation. So I do not want to stop my product business because it's a great business. I believe in it. Yeah. So the current business, which is generating money, which is a 15 million bootstrap. So at this stage, what you suggest me? Should I go for a VC or a private equity? Or should I wait for something else?
I think it's the size is VC size, not private equity size. You've got so many buzzwords. Many of us are already liking it. So write to any of us, and we should have a long conversation on the sidelines.
Sure. Thank you so much.
Thank you for your questions. Could you please stand for a group photo, please?